Hello, everyone, and welcome to BFW 2401 Capital Adequacy Week 11, and this is part 2. So this is a continuation for the first part, and we are talking here about continuing the introduction of capital adequacy requirements, namely Basel III. Now, please allow me to share my slides and start this. So we are talking actually here, and we are talking about the capital adequacy and the regulation on week 11. As you understand, and as I have explained, this is actually related to the capital planning. They are discussing the same issue. However, in capital planning in week 5, we were talking about the private incentives and governed by what we call the target capital, and the target capital is governed by the trade-off between risk and return that increases shareholders' wealth. This is when we talked about week 5. In week 11, which is this week, the issue is different, and it comes from the regulators. The regulators will give us some tables, and we have to apply, and it's very structured. So having said that, I move to this is where you can find all this information in the book. I have tried to summarize it as much as I can. I did actually my best to summarize it and to make it easier for you to follow through my slides. Now, the learning objective, we want to learn about the measurement of capital and its functions. So the function of capital and its and the measurement. We want also to understand the difference between what we call the simple leverage ratio, which is actually the capital over the total assets, and this new thing, which we call it risk-weighted assets, or when we have to use the capital adequacy to Basel tables to calculate the assets. Here we just take the total assets. Here we have to take something called risk-based assets, and most of our work in this week is actually to calculate how much is the risk for each single assets. We want also to look at and we have looked at it actually in the first part, which is the development of Basel from Basel I to Basel III. Don't worry about this issue. We already explained it in part 1. So it's just some historical perspective. We want to understand the framework. And the framework is not only calculating the ratio, the capital adequacy ratio, which means how much capital, but that is called Basel I. We want also to understand Basel II and Basel III. Basel II is about the governance inside the bank that will decrease the risk. And Basel III is about the information that the bank should provide so the outsiders can react and decrease the risk by, of course, controlling the share price. If you are risky, your share price will drop. If you are not risky, your share price will increase. And this is what we call it, the market discipline. So this can be activated only if you give them information. And Basel III is trying to push banks to provide enough information to disclose information to the outsiders so they can activate what we call the market discipline. We want to learn how the Australian Prudential Regulation Authority APRA measures capital, which actually applies also to the which also applies to Bank Negara Malaysia or the Central Bank of Malaysia, and also to some other banks. So it's not only about Australians, because if we are talking about the Basel Committee, Basel tables, it's applied across the board. We want to understand the meaning of risk-weighted assets and their use in measuring capital adequacy. We will be certain how to calculate the adequacy of financial institution capital base. So we want to calculate the capital also, and also the risk-weighted assets. So the whole formula is coming through this package called Basel III. We want to learn about the regulated capital buffers. We have two buffers, 2.5%, and we will discuss about it when we come to the capital requirements in part 3. And we want to understand the rule of Basel II and Basel III, which I told you, this is about the governance and this is about the information. Having said that, you can see my agenda here is all those, but the blue fonts is actually what we are going to cover in this part, which we want to do some introduction, talk about the capital and the insolvency risk, and we talk about the capital management. So the major functions of capital, and as we have seen it before, we are talking about, actually to absorb unanticipated losses, to protect insured and insured depositors, bondholders, and creditors in case of insolvency. Now we understand they are insured at 250,000, but what if a business or investor is investing more than 250, is not protected? So we need to see the bank surviving, and therefore they have to have enough capital to absorb any losses. So we want to protect the financial insurance funds also, because when a bank collapses, the insurance funds, which is the insurance companies like PIDM in this country, will pay for those customers and those depositors and bondholders. Now, when you have enough capital, you can actually protect them also, and you are protecting the system in the same time. You want to also, because if you are risky, you have to pay the insurance companies, and those insurance providers will ask you for more premium. You want also to pay less premium if you are less risky in terms of capital. So if you are less risky in terms of capital, of course, the calculation of the premium that you have to pay will be less by the providers of those insurance. And if you collapse also, the taxpayers will pay. And if the day, especially if you are too big to fall, so this is also protection for the taxpayers. So we are protecting the taxpayers, the insurance companies, less the depositors, the bondholders. We are also decreasing the premium, decreasing the cost of funds. And also we can use this money of the capital for investments. So it has major function, but too many functions, but the major function is to protect the cost of those stakeholders. But also you can use it for investment. As you know, sufficient capital levels inspire confidence in the financial institutions by the market. And as we are operating in this trust economy, its confidence is very important. Sufficient capital is sure that the bank is continuing. So the ongoing concern is actually is secure that, and we think that even in difficult times, the bank is actually continuing. So a going concern is an issue that we have to address in this issue. So going concern means the bank is going to continue in difficult times. And of course, difficult times mean more losses. More losses, that's fine, but if you can absorb it by enough capital, that will be good. Now, when we define capital, we already know capital is actually the net equity, and we have the book value. We know this in accounting, and it's actually the assets minus the liability according to the book. And this is we call the book value. This is how we define capital. But there is another definition which comes through economists, which is we have to look at the market value of assets and liabilities, and this is actually we get the net market value. And this net market value definition is actually preferred by regulators. Sometimes the bank is already insolvent or bankrupt, and we don't know if we are working with the booking capital, what we call book value. The book value, you can already bankrupt according to the market value, and nobody knows. So it can book value if you are using book value, and you see there is some capital, but actually if you evaluate everything according to the market value, your assets and liabilities, you may have minus equities. And this is why we say the book value can be misleading. This is just a small example, a brief example. We have seen it. If you have these banks, we have two banks, Bank A, Bank B. Bank B has 10 capital, and this one has 5 capital. So as you can see, this is less capital. If both banks were subject to $9 of losses, just an example, this is $10 capital, this is $5. As you can see, with the $10, if you have 9 losses, you can survive because you still have $1 capital. Here, if you have $9 losses, if you write off, which means this is a losses, then in this case, actually, you are bankrupt. And you can see you are bankrupt here because you cannot touch because your capital is done, and you cannot tolerate all of this risk of write-off. It's not, your capital is just not enough. So you are bankrupt in this issue, and you can survive, and there is going concern here. Capital management and measurement, we have two regulated capital. Financial capital guided by 2 key factors, by the regulations, as I told you, which is week 11, and by the risk return, which is the private sector, which is week 5. This is 2 things, and this is why we see in the report, we say, for example, Basel now regulators is saying 10.5, but you can see some banks holding 13, 14, 15. Are they inefficient? No, it just maybe the risk is more, and they are keeping the minimum and then extending over that. So we can measure capital adequacy, as I told you, according to the leverage ratio. But now, according to the regulators, we use what we call the this one, which is the risk-based capital ratio, which we have to assess the risk in each single asset. As you know, this week 11 is focusing on this red thing, which is the risk-based assets, risk-based capital ratio. I'm done with these parts, and hopefully I will see you in part 3. For sure, I will see you in part 3. Thank you very much. And we'll see you in part 3. Bye-bye.